Good evening, ladies and gentlemen. Today we're going to be talking about the housing market, Powell, everything from the sun, oil, Apple. It's going to be a jam-packed week. So pretty much said for the S&P, really bad week for the bulls out there, really great week for the bears. So recapping S&P real quick, we closed at the low of the week, basically nearly within $1 of the low. So again, that's pretty bearish out there. Will it continue? Most likely you get 3 cuts. You get the consolidation, the 2 big red candles. If we go back in time, consolidation, 2 red candles. Consolidation, more than 2 red candles. But let's say at minimum we get 2 more red candles. I'm going to be hypothetically looking at this area here, if not for one thing that I will cover in the key level section. However, if you guys kind of clicked on the video for the housing market quip, here's a hard truth about it. Now, if you follow XHB, which is the housing sector or home builders, it's pretty much repeating what it did in 2020. So here's the hard truth that you have to realize. This is, by textbook definition, the double top. You double topped at the 84.50 mark roughly, and now you are heading lower. You're heading lower at least to the $71 price point, and I would say at least down into this area right here of where you're finding support. I do believe the rest of the market is going to follow suit. However, there's some things that we have to look at. For home builders, there's no price action between the $71 mark and where you are now. So you're basically getting a haircut whether you like it or not. Now, does this mean that the housing market and all these videos that you guys see on the internet about housing market crash and all this, there's no evidence, and I recommend you guys watch Clearview Tax's video on the housing market and how there is no evidence that there is a nationwide housing market crash in the development. Not talking about commercial real estate, I'm talking about residential. People are, some of the facts just to quickly give you a too long didn't read version, people have a lot of equity in their houses, they're locked in at low rates until the Fed bleeds them dry, which can happen. You haven't had the evidence yet, it's hypothetical, it can happen. But to bleed someone dry will take you approximately 6 months to a year, and who knows what rates are going to do, who knows what inflation's going to do, and we'll talk about that in this video, basically what I think inflation's going to do, what the PCE is going to come in, all that. But we need to start looking at the facts. What I always say on this channel is trade the charts, don't trade your opinion. Same with the housing market. Trade what is there. Don't expect to hear someone's thoughts of, hey, we're going to see a housing market crash. Well, congratulations. You can be wrong. They can be wrong. A lot of things can happen. There's no evidence in my opinion right now. And if you guys have some evidence, please throw it in the comment section to share with everyone. It'd really be interesting. But as a nationwide view, there is not a lot of housing supply. Home builders are not basically going like they went back in 08, where if you look what happened in 08 to these guys, it just basically was a slaughter fest like no tomorrow. You really haven't seen that yet. This was like the preview, I would say, to that. But until we start breaking below this moving average, the 200 weekly, I wouldn't say that you're going to get that nationwide housing crash just because these guys would be the first to go. On top of, you really don't see people not able to pay their mortgages as of yet, and all these things have to come to fruition. They take time to come to fruition. So if you're expecting a 10, 20, 30% housing cut, especially how the Fed is not aggressively raising rates like they were back a year ago, then I don't see necessarily that going up. On top of, yields are causing a depression in supply of homes for sale where demand really hasn't been affected. I recommend you guys always look at the CPI, PCE reports to see what the shelter inflation is doing. Until you start seeing degradation in shelter, there's absolutely no way for a housing market crash to occur. And basically that's kind of the sum and substance of my little 2 cents on the housing market. I hope you guys enjoyed that. But jumping back to really recap the week, there's one event that we just got to talk about. Like, nothing during the week mattered. You had building permits come in, but just segueing from housing, they went higher because there's still pent up demand. However, housing starts are still kind of slowing down. You still got over 1.2 million. So until this is going down into the 500s or half a million home starts, you're not really going to see that carnage per se. Again, look at the evidence and tell me where you see this housing crash if your theory is that. If not, there's a lot of evidence to support what you're thinking right now. So FOMC 5.5, 5.5. They didn't raise rates. We covered that in the live stream, and it was quite interesting, especially the market got exactly what it wanted, but I guess the market wanted the moon on the stick. So, I was looking in the bearish sense. I thought they were going to hike, and then when my position went in the money and I was happy with that, I was pretty ecstatic about that. And I made money on it. I didn't really understand the trade, so I got out of it early. Could have made a lot more money, but that's a lesson for you guys. If you don't understand the trade and you don't feel comfortable and you're in profit, well, maybe it's time to take that profit and run and then reassess at a later time. You can always re-enter. Initial jobless claims dump again. So this is another thing that I've been harping on this channel, that job market is still blazing hot. The continuous jobless claims and initial jobless claims both going down significantly. However, the previous number did get revised higher. So again, kind of maybe what we're going to see with the non-farm payrolls, where they're going to start revising some of those previous estimates higher and then these lower, kind of trying to compensate each other out. Philly Fed Manufacturing Index absolutely in the toilet. So, the soft landing is really cratering, similar to how the housing market crash theory is cratering as well. I kind of like that pun. But before I digress, net speculative positions went up kind of as expected, guys. Like, if this didn't increase, then I'd be shocked. I did say I could see where it would go down, where they would try to cover, but due to this move being so large, I do think this is a steady ad. This is not over leveraging. They're just kind of taking their profit opportunity to kind of maybe make up some of the losses they were handed earlier this year. And who knows, maybe we're going to see a breach past the 400 once again in the next year or so. I'll keep you all updated on that. And now Fatal's going to take it away with the biggest winners and losers, and I'll be back for the key level section of the video.
With the Federal Reserve coming out this week and pausing on interest rates, however, at the same time saying that there will be another interest rate hike this year, it's not surprising that the S&P 500 fell about 3% on the 5-day. When looking at the most anticipated earnings, we can see that there isn't anything notable here. Only ones I could think of would be AutoZone on Tuesday and General Mills on Wednesday, as well as FedEx. And that really is it. There really wasn't much to see of anything when it came to the earnings. So with that said, let us take a look at now the heat map, and this is a bloodbath, as you guys can see right here. Most of these companies / sectors are in the red. So let's start off with none other than the technology sector. Here, the worst performer was none other than the company C-Day, losing almost 11%, and the best performer would be the company Western Digital Corporation, gaining 3.53. However, if we take a look over here, guys, we got Tyler Technologies gaining 3.52. Looking now into the communications sector, worst performer here would be none other than the company Paramount, losing 10.10%, and the best performer would be Activision, gaining 2.29%. Looking at now the consumer defensives, we got worst performer here being none other than the company Clorox, losing 9.26%, and the best performer was none other than the company, by the looks of it, guys, it's the company Kraft Heinz, gaining 2.12%. The healthcare sector has by far one of the greenest sections that we have seen thus far. Worst performer here would be the company Moderna, losing 12.74%, and the best performer, it is the company Humana, gaining almost 5%. The financial sector right now isn't looking too hot. Worst performer here, it is the company PayPal, losing 9.9%, but guys, you also had a bunch of other ones that were kind of in the same realm. Another one would be the company KeyCorp, losing 9.5%. Best performer though would be the company CBOE, gaining 5.25%, as well as Allstate, gaining 4.88%. The consumer cyclicals is massively in the red, with only a few ones being slightly in the green. Worst performer here was the company MGM Resorts, losing 11.05%. You would think it would be Tesla, but no guys, it was actually MGM Resorts. Now, the best performer here, there's only a few of them that were in the positive. I'm just gonna say it, guys, it is Rollins, gaining 1.08. We got AVY gaining 0.17, O'Reilly Automotive gaining 0.63, and AutoZone gaining 1.6, with AutoZone being the biggest gainer in this section. Looking now into the industrials, this one is once again very much in the red. Worst performer here would be none other than the company Deere & Company, losing 7.6%, and the best performer would be the company FedEx, gaining 2.76%. ARE losing almost 11%, and the best performer, by the looks of it, wow, that's actually really hilarious, would be the company CSGP, losing only 1.34%. Now, when taking a look at the utilities, everything here was in the red except for two companies. Wow, okay. Worst performer would be the company AES, losing 7.42%, and the best performer was the company Zell XEL, gaining 3.04%. Now, the energy sector, gas prices, even though they're going up, well, this one's still going down. We can see here that the worst performer was none other than the company EQT, losing 7.42%, and the best performer, really easy to find, was Valero, gaining 1.11%. And lastly, when it comes into the basic materials, we got the worst performer being none other than FMC Corporation, losing 9.6%, and the best performer, by the looks of it, is not yet. Well, wow, it's the company CF Industries Holdings, gaining 2.57%. This is really unprecedented, as y'all can see right here. Massive bloodbath this past week. Even though the Fed did pause, for some reason the market just was not having it. So yeah, a lot of people thought we were going to go up, but apparently we didn't. This goes to show that we can't really know what's going to happen, right? We have no clue. And yeah, it really is interesting. Now, this was probably caused by the fact that more interest rate hikes are expected by the end of the year. But again, I mean, who didn't see that coming, right? So that pretty much was it for this section. Take it away, Mike.
So taking a look at the S&P, we're going to start off with it today. The weekly range is what we established, 440, 497, and 430 is your range for the next week. So it's a pretty clear-cut case of if you come back to pivot to this gap right here, that's where I'd be looking to turn from a bearish sentiment to a bullish sentiment on the market. However, if we keep printing lower lows as we are doing now and breaking the support pivot point here of basically 449.67, which is only about 30 cents lower than our bottom support. We break this, there's not a lot of price structure. We may have a stop right here around the 424 area. However, that could be the dead cat bounce before we flush down to the lows of possibly the moving averages sitting at the 415, 409 area. That's where I'd be looking for the true, like, buy the dip opportunity. But this price move action right here, not supported by a large amount of volume, and there is substantially more bearish volume than there is bullish volume on the S&P. So until we get back above the 435.70 level, then the bearish trend will continue, in my opinion. We could start going sideways here and forming basically a zone that we could break out to the upside and downside. But if we just continue to keep sliding, I wouldn't really change my tune on being bearish on the market. Probably start selling calls to profit from this downward move, because the trend is your friend till the end, as they say. And there's a lot of work to go to get back to the upside of the weekly breakout, which would be approximately 4%. So pretty gnarly week on the S&P. NASDAQ, even worse case story here. We broke our support. We're pivoting close to this low right here, which is around the 354.20 mark. If we break that, which there is more substantial move down here possible. However, if you break that, what I mentioned just now, there is little to no price action. And I mean little to none at all the way down to the 320 level. I guarantee you pretty much that we would shatter the 200-day moving average once we got down to that level, because there's zero support there. Like, the bulls would have to defend extremely hard on price action that's not really been there very long. The NASDAQ had a parabolic move up. So if we consider this a parabolic correction, you guys are not going to like what I'm about to tell you if you're bullish this market. Parabolic corrections normally retrace at least 60% of the way, which would be down into this area where we have price action breaking both the moving averages and then possibly bouncing on the 200 weekly, which is not a situation you would want to be in, because then you're in the kangaroo between the moving averages, kind of just range bound there. So right now this is pretty bearish, and we need to get back above that 50-day, the trend line, and various other things to really be bullish the market. Now, we do have a gap to the upside. I could easily see the rotation of fill the gap, run back down, break the trend. That's what I'm going to be looking for the NASDAQ. The S&P is going to be my bullish indicator out there, and that's really going to be the true substance of the story for the week. It's you stay bearish until something provably shows you differently, meaning we fill this gap, we hold this gap. On the NASDAQ, S&P, we fill the gap and keep going. That's what's going to be my story for the week and how I'm going to trade it. Until then, I'm not going to be looking for any bullish plays out there, especially how we closed at these lows. Bears weren't able to break you, but the bulls weren't able to hold you either. So it's kind of a tale of two stories. Now, I'm going to jump to a couple charts real quick so we can understand where on the NASDAQ and S&P could be going. Again, to quickly recap, the NASDAQ 371.79 is your breakout point. You need to get above the trend line, break down below 357 and then into the 352 area. Sorry, 354.20 area. That's going to be your basically point of no return if you print anywhere near this lower point here, setting up that nice A to B pattern, confirming and heading much lower. And 361 is going to be a point I'm going to keep an eye on, see how the NASDAQ interacts with that. Now, to talk about why I'm not totally convinced that we're going to get a sell-off. And you guys may be like, whoa, you just talking about all this selling. Why are you saying we're not going to get a sell-off? You haven't broken Apple. Apple has not broken this trendline support. It's really close to it, and it's coiling and coiling. But until Apple breaks significantly downwards or upwards, I'm not going to say that we're going to get a bullish or a bearish move. It is consolidating around this previous price point here, so that is a strong bounce in this area. However, until we get a move on Apple in the short term, and we need one quick to really decide which way we're going to be going. If we look at Microsoft, again, holding the lows similarly to Apple. Amazon just dumped like no tomorrow. Google actually closing below its 50-day moving average. And Google, here's the scary part, and why I'm not totally convinced we're going to get the bullish story either, is if Google comes back down through this price action and starts filling this gap right here, then, well, it's going to be pretty obvious of where we're going to be going. As you can see here, the dominant volume on Google is bearish. So all these bigger companies, only Google and Apple are really the ones holding everything up. If we look at NVIDIA broke the trend line, rejected off of it. This is just bearish on every regard. Gap down, reject, can't get back above, fill gap, second rejection. I expect NVIDIA to go down lower. If we look at AMD, AMD's coming down to the 200-day moving average, $96 roughly. So again, no price action in this area. The moving averages are going to be your kangaroo there. So it's just looking really, really bad. And all these charts are basically saying the same thing of there is more pain ahead. Especially like Netflix, for example. Netflix coming down to the 200-day. All these things happening until Apple breaks. That's going to be your indicator. Watch Apple like a hawk. Microsoft, you got to see if it breaks as low, completing this head and shoulders. Now, it's a pretty obvious pattern, so it may not play out. All usual obvious patterns don't necessarily play out. But if they do, guys, just take the free money and run. It's free short money. So again, that's the strategy I'm going into this week. Now let's just jump over to VIX dollar and yields along with our good friend Dr. Oil. So first we're going to go over oil. Oil, sad to say that we have a new A to B pattern. For anyone that's bearish on oil, well, maybe invite me to your funeral like Jim Cramer would say. But again, looking at oil, looking new A to B pattern completing at 103. Hasn't been confirmed yet, but if it completes, oil's coming to wreck everyone's face, along with the PCE and the CPI reports. That'll be its first victim, and then the oil bears afterwards. So again, we have to keep an eye on that. Oil just pumping up higher, price full on bull flag here, bull flagging here. Can we get that nice break? Are we going to hear some more oil news in the future that's going to skyrocket oil, or are we just going to kind of go sideways for now? That's what we're going to have to be determining then. So first, let's dive over to the VIX. VIX actually had a very interesting day. It actually pushed up massively and didn't actually close too bad for the week, where it sold off pretty much on the day. If we go to the 15-minute, as you can see here, pushed up, kind of sold off, but really held that day. It had that nice big push, sold off during the day, but really defended those lows. So again, VIX having a really nice print on the day, consolidating around this area, which is good because you're not really seeing it give up the goose like similar here. But can we get past and break up towards that $20 level? Are we going to see true fear in the market? Right now, we haven't really seen true fear. Once we get into the 20s, the 25s, that's when really fun stuff happens in the market, where real carnage starts to happen. Dollar, well, this story is getting really old of let's just keep bouncing on a trend line until we keep going higher. So the dollar basically regaining status, coming to a key resistance point here around the $105, $106 area. So if it can break out, especially with Powell's speech really didn't take any fuel out of the dollar. So the dollar is basically saying, hey, I want to go higher. And traditionally stocks go lower. And last but not least, the 10-year yield pushing up, breaking out, forming a new W, as one could call it, where you're basically, look, if we go to the weekly, we can clearly see we got the nice W forming here. Last time that happened, we got the October low printed for us. So again, we're gonna have to keep an eye on the 10-year and the 2-year significantly. Right now, I do believe this is a technical pullback. I don't believe this is off of Powell's speech. A lot of people basically going into bonds and obviously going to drive the yields down, along with the 2-year having a nice pullback, possibly sending up an A to B pattern on the way up, which, if let's play that pattern out. If we hypothetically, off the recent low here, get an A to B pattern on the way up, projecting us to 5.522% on the yield, which would then indicate that, hey, the Fed's got another rate hike in store, especially where the yield is sitting at now. It's pretty much indicating that if you look at the 3-month, we're still sitting at 5.5%, meaning no one's discounting the Fed hiking again. So we just have to keep an eye on that to really give us an indication of what's going to happen. And now quickly, we're going to recap the news for next week, and then we'll go into the debate section of the video. So starting off Monday, we got Chicago Fed national activity, nothing real much. We got Gakarshik speaking. I don't see that moving the market much. Building permits and month-over-month and year-over-year coming out on Tuesday. Interesting to see, especially how my housing market comments in the beginning of the video play out. Will that continue to show data that supports not really a big carnage in the housing market coming? Now, residential, not commercial, guys. Please separate the two. Consumer confidence coming in expected slightly lower than last month. So again, has the consumer's back been broken yet? New home sales, that'll be an interesting point as well. Kind of just harping on the whole housing market thing. We got core durable good orders on Wednesday, no expectation yet. And then on Thursday, we got continuous jobless claims coming in, core PC prices, and then GDP. GDP is expected to come in basically in line or slightly up from the previous month, and then pending home sales. Now, core PCE comes out Friday. That's going to be your big news of the day. We still don't got expectations, guys, so we have to take that with a grain of salt of where we go from there. When we get this, I'll make sure I'll make a video probably Wednesday about what the PCE and how to prepare for it. But again, we're going to have to see how this all plays out. Throw it down in the comments section of what you guys think this is going to come in at. So now we're going to jump over to the debate section of the video. I hope you guys enjoyed. Throw a like on the video. It really helps the YouTube algorithm out. And if you guys want to minimize it after now, it's just a talking point video, we greatly appreciate your time. So diving headfirst into the madness, sir, what is your PCE expectations?
I have no idea. If CPI has anything to say about it, we'll probably go up.
So right now, like we just talked about, personal spending expecting to kind of like go down. But again, this broken record thing of 0.2% increasing month over month, I'm like, okay, well, let's see what it did last time, right? Maybe that'll give us some insight of what's going to happen here. So looking at it, we had the classic, right? You know, the classic thing about CPI did 1, 2, and then 3. So is PCE going to do 1, 2, and middle finger?
Probably.
A high probability. But
very high probability.
So with the market sell-off, I hope you haven't seen the CME tool yet. And where do you think... Hold on. We're going to play a little game. So, ladies and gentlemen, throw down in the comment section what you think the Fear and Greed Index is, and then throw down what the CME tool is telling us now. So we're going to go to Fear and Greed first, but I want you to guess, are we in fear, extreme fear, kind of hovering out fear, neutral?
We're like teeter-tottering between fear and neutral now.
And ladies and gentlemen, he is incorrect. We're straight in fear.
Wow.
So...
Okay, I did not... Oh, wow.
Yeah.
Back in the
Now,
middle.
we haven't gotten to the juicy bit yet. So we're in fear because if you look at actually stock price strength, it's like meh, but breadth is going down significantly. VIX is going up, safe haven demand, extreme fear. We still got junk bond demand. We haven't pulled that trigger yet. We haven't gone, we're still in extreme greed there. So the bond market is basically not full throttling yet, but this is a good thing. Now, everyone's saying, oh, we're going to come out. I'm like, look, you spent an extreme amount of time since April in the greedy territory. Why can't you spend a little bit more time down in the fearful territory? Especially quoting Powell's lovely, lovely, lovely statement. If you guys didn't watch the CPI live stream, it'll be linked down in the description below. The soft landing is not our base case.
Well, wait. Let's give it some more context. The soft landing is in our base case, and then a few minutes later, we never said the soft landing wasn't our wasn't our target.
Talk about talking out both sides of your mouth.
I really wish you could have found that like on the live stream for the FOMC.
But what I'll do is for this stream, I'll try finding it if I can. I'll clip it into this video. If not, I apologize to everybody. But
yeah, if anything, guys, on the live stream we did show, I believe it was what, breaking news financing.
Yep.
With the exact quote, right? Yep. With the exact quote. So
which was great. When I heard it live, I think I fell out of my chair. But yeah. Now the creme de la creme, as I like to call it. What is the CME tool saying?
Oh boy.
Yeah, you gotta give a guess.
I have to give it a guess. Okay. Ooh. Are we still saying that there is no cut coming? Oh, sorry. Are we still saying that there is no hike? Oh, it actually
got worse as we went on. Last week we were at 72% chance. Now we're at 74. They just keep on holding to that hope that we're basically going to get a nice little pause still.
Yeah, but here's the thing. We got the pause.
No. Their version of a pause is we never hike again.
Right. No, their version of a pause is we never hike again and then we start cutting. But there is nothing in the dot plot, which, by the way, we did cover. There's nothing in the dot plot that says that. Sure, there's a few Fed members saying, "Oh yeah, we don't want a rate increase," but majority of them do. So I don't know where this is coming from. Well, you and I, right? You and I, we were wrong because we were like, "There's no way that they don't increase. There's no way that they don't increase," and they didn't.
Which. Let's take a pause and go down that journey lane for a second. Does it mean they know something's actually broken? Or do you think that they're hoping, emphasis on the hoping part, that they don't get this to increase?
Well, okay. I'm about to say something that I know will get a lot of people mad and might even get you mad, Mike, but you know, it is what it is. I don't like the Fed. I don't like Powell, but let's just take his word for it. Let's say that he's correct. Let's say that everything is perfectly fine still, and they're just waiting for more data. They're just like pressing a little bit on the gas. Well, they're just taking their foot off the gas for a little bit, just to make sure that we're not heading into the light pole yet. We're still heading in that direction. We're still heading into smacking our faces onto the brick wall, but they're easing off of the gas pedal just to make sure that there's still some time left. Let's just assume that, right? If you assume that, then, well, I guess we're still fine, right?
Any of you heard that famous meme, "Everything's fine as the whole world burns around you"?
Yeah. No, I'm aware, but, you know, okay, can we see the future? No. Are we a fly on the wall in the Fed's boardroom? No. So the most we can do is just take Powell at his word. Because at the end of the day, right? We can speculate, we can fight against him, but it ain't doing us any good. So best thing to do is just take him at his word. He's been saying this, by the way, for months now. We're gonna be data driven. That hasn't changed. You even said it yourself during the live stream. It's a carbon copy of the last FOMC meeting.
Oh, yeah.
It's a carbon copy.
Now, if we're saying data-driven and data-dependent, this SOAR data point would like to have a track record of nearly being 100% accurate in predicting every doom and gloom that comes our way almost. And it's screaming at the top of its lungs. And we're slowly approaching the line on the yield curve. And for those that haven't watched this channel before, the yellow line is where we meet the '08 recession, basically length of inversion. So when the yield curve went, basically the short term is longer, higher interest rate than the long term, 2 versus 10. And the red line is when everyone dies. So that's when you meet the Great Depression anniversary. Orange is my hypothetical. That's where I think. But we're slowly heading towards the yellow line, and this thing ain't going down. And
how many more months till it touches?
1 month.
One. So
26 days. End of October.
November, huh?
Yep, okay. End of October.
End of October. Oh, lovely. Oh, lovely.
End of January is where everyone dies, but we're not going to talk about that yet. That's when we're going to we'll see what the market does. Now,
Yeah.
some of the things, other data points I want to point out. 10-year looking like it wants to eat someone's face off again. Did have a
Wow.
pullback today, but I'm like, yeah, you just went on an astronomical run.
I mean, you've had pullbacks before in the past.
Yeah,
It's not
but
like
you're literally as high as you were.
more
I
than more.
I have to go to the monthly view, guys, to show you this.
Wow.
We're back in '08. We're now back
Wow.
in '08 territory.
What?
Yeah, we haven't been here in almost 2 decades.
The 10-year yield. This is the yield.
Yeah,
The 10-year yield is as high as 2008 right now.
not the peak,
What?
but in that
Not,
area.
not the peak, but in that area. Yeah.
Yeah.
What about the 2-year?
So let's go to the 2-year graph. I think that speaks for itself.
It's the same.
I don't have to say anything here. I think that speaks for itself.
Okay, is it a W formation? Am I
No,
looking at that
it'd
correctly?
no. You can kind of construe it as a very wonky W, but no, just
Well,
because it's too rounded,
Okay.
and you can't
Okay,
say
you
cup
got-
and handle because
Cup
the
and
handle's
handle. Okay,
below.
dang it. It's supposed to cup and handle.
Hey, at least he tries, guys.
I try. I'm not good
But
at
this should indicate to you where the 2 years kind of going stagnant.
Yeah.
Let's see. When we go here, bad things happen. When we're here, let's put a mirror in between and you tell me what's going to happen. So, and if everything's fine, I'm going to put a couple holes in that everything's fine theory because I do enjoy doing that. So let's just go to regional banks.
Yeah.
Everything's fine.
So I just
Everything's
covered
fine.
the so I just covered the heat map. It's a bloodbath. It's a bloodbath, and the only sector that did somewhat good was the healthcare sector. The banks did not do too good. PayPal lost almost 10%.
Banks have
Yeah.
never. The only banks that are doing good is the bigger ones, and
Right.
they're like if you draw out this like general trend line, you're approaching where you're gonna find support. You're pinching at the moving averages. I'm like, you're entering what I call no man's land. You break this, target down here. This is no man's land here. So
Wow.
literally, I'm like, if everything's fine, like if you want to believe the narrative, it's like, okay, here's more evidence, right? Home builders. We covered this last week in deep dive. Lower low, heading lower, and I'm like, when was the last time we were here? Oh, start of 22. What happened afterwards? Dump. What's gonna happen now?
Wow.
Dump. It's like
Wow.
everyone wants to ignore it, and we've been saying on this channel, or specifically me, fighting the Fed is a futile thing. Done it, been there, don't enjoy it. The Fed always wins. Congratulations, everyone. You're learning that lesson now.
I just absolutely love the fact that the Fed gave everybody what they wanted. A pause. And market fell. So
That
it's
was
like, what?
probably the most surprising thing. It's like, which then means, what were you guys expecting? Like, what did you honestly think they would do?
And by the way, this was even before Powell came out, right? The interest rates announcement came at 2:00.
Yep.
Markets were pretty good in the green prior to 2:00. 2:00 came, and then it fell to 0, and then after Powell talked, it fell to negative 1.5. So
And it started
It just goes to
recovering
show.
during Powell, actually. And I
Yeah.
was like, oh, here we go. Here's the run. I even texted him. And I'm like, hey, here they're going to run it on Powell.
Yep.
Hey, I'm happy to be wrong. I could have made more money on it, but hey, I made money on it. I was happy. I'm happy that we got this nice sell off. And Daddy Oil. Last
Yeah.
but not least, actually setting up, like I mentioned in the key levels part of the video, setting up another A to B pattern, which is even worse than the previous one. You know why?
why?
It ends at $103 a barrel now.
Oh my God.
Yeah, it's like every time oil creates like a new price structure, it's like, why? Why do I even exist? And you had one here technically that stair step between 95 and 96. I really don't count this middle one because it wasn't a significant enough pullback. But once you complete the 95, well, 103 is the next target, and who knows what
Dear.
oil is going to come up with next. And if you're an oil baron out
mean-
there, congrats.
I mean, I sent you that article of somebody
300
saying $300 barrel oil.
So you know where they're actually getting that from?
No, I don't.
They're taking an A to B pattern off these peaks, projecting it to $200 a barrel, which they're assuming will project to the 161% mark of 275. But here's the thing: the same thing everyone said about the Fed, right? Everyone said the Fed couldn't raise rates. Let me just go to the yield curve so we can show what we meant. So the Fed during, need to go to the monthly for you guys. So if you look at historically the federal funds rate, it has been decreasing. So everyone said, hey, you can't get above 1.5%, right? Federal funds rate.
Yeah.
Fed said, hold my beer. So I was one of them. I'll admit it. I was one of them. I said a lot of people. Those are the consensus with a lot of people, and a lot of people were proven wrong. Same with oil. Oil, we're never going to see. I remember people saying back over here, we'll never see $200 a barrel. There's always that hold my beer moment in history that no one sees coming. But right now, what's stopping oil from going up? All Saudi Arabia has to keep doing is closing the spigot.
Yep.
And there is nothing in the world that anyone can do
to stop him.
Especially when the United States is revoking all its previously issued drilling permits.
Oh, is that so?
Yeah, that happened like a month or two ago. That's what caused this. It wasn't even the Saudi news that really caused it. It was when Biden, not getting into politics, said all the permits they issued 2-3 years ago, yeah, they revoked those. So now you have Zippo new drilling rigs coming online. And
on federal land.
Yeah.
On federal land.
Yeah.
Yep.
So like private sector, yeah, but private sector is meeting the demand of the current stuff. And if you're a corporation, do you really want to sell your oil cheaper? Like you're looking at Saudi and being like, thank you. Our profit margins are going to be nice and gross.
Yeah, absolutely. And man, this market falling like this is just ridiculous. Now, you made some pretty good money on the Fed, on the downfall of that. Meanwhile, I'm over here getting screwed with all these puts I had, thinking that they were going. Which, by the way, in my defense, right? In my defense, I sold these puts with like $5 to the strike.
Now,
so $5 out of the money to the strike for a month out. So that usually ends up going pretty good for me. And then today, I literally had one of the puts I had for the company DLR. The company fell from 126 down to 123. So I'm like, all right, I can't do anything about that. So my personal suggestion when it comes to this kind of market, guys, it's time to accumulate shares, right? It's time to actually just start buying up shares. I mean, Mike, if you want to pull up, I'm going to pull up a few tickers here. Ticker of O. Right, ticker of O, just the letter O. Look at that drop right there, baby.
O is correct.
Drop. Yeah.
Look at that. You're actually right, like, from a technical perspective, you're coming into a ginormous volume node over here.
Yeah.
So that you told me $50 a share on this one. You would be buying like a mortgage.
I think I said 55. Yeah, I think
I could have sworn you said 50. Yeah. But okay, next one.
Next one, pretty much anything in the real estate sector. CCI, look at that one. CCI, yep. Look at that. So this is what I'm talking about, is that right now it's the time to buy into these kinds of companies. Now, these are just real estate companies, which, I guess from a dividend perspective, non-qualified dividends, I guess you would prefer qualified dividends. But still, though, this is a massive, massive drop. And I think
life gives you lemons, make lemonade.
Exactly. So I'm looking at this, I'm just like, you know what? It sucks that I'm losing on these put, but you know what? I'm just gonna roll them. Another one that fell, and I was surprised by this because you were here. You were here when I talked about it, like in my house, when I talked about this company, and I was just like, this thing doesn't fall. Yeah, it's sub 100. TXRH, my friend.
Texas Roadhouse.
Yeah, it's sub 100. What? I had to roll this thing for next month. The strike is 105. It's at 95 now, and I'm just like, what is going on? So, regardless, I will keep everybody updated on my whole put situation on the monthly dividend video. But basically, I look at this kind of scenario, and I'm just like, you know what? Sure, I may be losing on the puts, but now it's a great time to buy out a bunch of these companies. It really, really is, right? It really, really is.
Now,
low price meaning higher yield. So if you believe that they'll recover, I think it's a great time to buy.
Now, I need a non-technical person's perspective to say something real quick.
Go
I'm
on.
going to point out something, and then you tell me if it's pretty obvious to you or not. What does this all look like?
I don't know.
What pattern
Head and
does it
shoulders.
have?
Head and shoulders.
There you go. Okay, so
Oh, I actually got it. Okay.
yeah. Now, here's the problem. When it's that obvious, it never comes to fruition, or rarely, with indexes. Now, I'm being specific with companies are different, guys. So the last time we had a very blunt and obvious head and shoulders, aka
Wait, is the head the middle one?
yes,
Is the head the middle one?
Yes, you're right. You're right. Okay, last time we had a head and shoulders, left shoulder, head, right. Yeah, we basically said screw your head and shoulders.
Got you. Head and shoulders is a
Yeah.
bearish.
Yes,
thing.
correct.
Okay.
So here's the thing. Yes, it can play out if it breaks this support down here. But the market really wasn't, and if you guys saw my video, I was saying that, hey, gap up here, probably going to rip up higher, fill this gap. We haven't really sold off, and now you're digesting that Fed news where you're not really making more progress to the downside. Now, if we open up Monday and blow out this low and just keep going lower, okay. Head and shoulders probably going to complete. But you haven't broken this localized low down here. So therefore, this could easily play out to a gap fill to the upside, and all his puts may actually expire out of the money. Remember, everyone kind of is going from one side to next. In fear, everyone starts selling, aka it's the wrong move. Everyone sells support, as they say.
And Mike Burr even came out several months ago being like, there has never been a generation of buy the effing dip as you guys. So who knows where this is going to turn out. We thought the market was going to skyrocket when the Fed paused. That was clearly didn't happen. So for all we know, things could just come, I don't know. And then on top of that, we also have a government shutdown looming. So yeah, that's another thing that we should probably talk about.
It's not
in another video.
Yeah, but that one, like, I'll leave you with these closing thoughts and one thing to look out for the week, and then we'll wrap up. But with the government shutdown, it was like with the debt ceiling crisis. It was overblown to the last second, and you didn't make money off of it in any way, shape, or form. And I don't think this one's going to be any different. I think just completely ignore it. It's a distraction, and keep an eye on Apple. Apple is still holding its trend line, which I'm going to adjust just momentarily. It's still holding this trend line. It's invalidating this, possibly setting up a W. So keep your eye on Apple if you are a bull. If it starts pushing up higher, the market itself will push up higher and could be an interesting buying opportunity down here.
Well, I'm actually going to fight back a little bit on the whole government shutdown because yesterday I was watching Tim Pool and Matt Gaetz was on, and he said we are probably going to shut down. But neither here nor there. We'll probably make a separate video on that if it actually ends up being anything. But anyways, guys, that pretty much does it for this video. Y'all can follow us on the new Tech Sites link is in the description below. Make sure to like, subscribe, comment. It really does help here with the algorithm on Rumble as well as YouTube. So with that said, peace out, and we will see you all next time.